PE is one of the most difficult conversations to have with most investors, and it's funny because I used to be a research analyst, and when we go to the director of research, as I'm sure all the other MLP sell-side analysts do, and go to the director of research and say, I don't want to put EPS or PE on my particular research report for MLPs, the director of research says, why? This is the only asset class, you're the only analyst who has asked for this. And the reason, as it specifically points out, is because of the accelerated depreciation. So when you have massive investment in a lot of these high fixed cost asset type of structures, steel in the ground, among other things, oftentimes because of that accelerated depreciation, other deductions that they take, their earnings can be much lower or even negative sometimes for the smaller companies, right, who are just starting out. And so PE has never been the preferred metric from the asset class. I think if you look at some of the larger companies, it might be a more reasonable thing to use. We prefer, and I think if you look at sell-side research reports, they make the same argument of using price to distributable cash flow or price to EBITDA even, right? EV to EBITDA or different contexts like that and thinking about a multiple in that construct. For price to DCF, the range has been about 8 to 14 times in terms of where it's ranged historically over the past 10 years. Today we're at about 11 to 12 times or so, depending on the particular partnership. Some companies, as we talked about, are accorded a premium because of their consistency of their business model. The other thing that people look at, just as far as valuation is concerned, and we've had conversations around this, is understanding what the replacement value is, right? And if I were a private equity investor and I were to come in, what would I pay for this particular asset? And that's gonna range depending on how you think about it. I think most people would argue today that MLPs are probably slightly undervalued, but they're not wildly undervalued by any stretch of the imagination, right? And I think that's a testament to the fact that more people are looking at this space and are better understanding the dynamics behind it. So that's the concern with PE and the experience that we used to have in talking to the research analysts. And I know they've all made that point of trying to get that taken off even of Thomson Reuters or off of Bloomberg or off of these different reports, because it's not as valuable a number, and it's difficult obviously to make that comparison because people want to see a standard to be able to compare across different industries. But that's really the reason for the challenge, is that it's not necessarily always the most meaningful number to use for that particular reason. So analysts have tried to get away from it. Even the IR teams of management teams have said, if you could go and talk to, XYZ data distributor or whoever needs to be spoken to remove that particular metric, price to DCF or a variant of that, EV to EBITDA or price to EBITDA tends to be a preferred metric.
The caveat there is, of course, the maintenance capex and
yes.
Whether management's assessment is appropriate.
And that is a great point. Going back to the whole issue of how do you select securities, many people, because DCF is not a GAAP measure, it's important to recognize what that maintenance capex number is, right? And we spoke to that earlier about DCF does account for maintenance capex, but what is that number, right? If you're running a pipeline business, it can be a lot easier to calculate because it includes things like checking for corrosion and leaks and running what are called smart pigs through the system to detect for those kinds of things. It includes replacing certain sections that may be aging. It includes accounting for personnel that's involved in that process, treating, all those different types of things that are around that pipeline asset. But then you get into some different types of businesses. If you've got a coal business, if you've got an exploration production business where you're actually producing commodities that come out of the ground, well, is your maintenance capex just the assets that you're using to get that commodity out of the ground? Or does it also, or should it also include the replacement of those reserves? Because theoretically, you can maintain your drilling assets all day, but at some point you're gonna have no reserves left. So shouldn't that be part of your maintenance capex equation? So that's a very tangible example. Even a gathering and processing asset, for example, gathering lines are basically small lines that run from the actual production site to a larger trunk line that then runs to specific locations. So even with gathering lines, if I'm connecting to lots of different small new producing wells, well, at some point that well's gonna run out. So theoretically, I need to account for that in some way in my maintenance capex as well. So you make a great point about that as it relates to how do you think about maintenance capex, and are you being really conservative enough in accounting for that particular number?